All right, let's get right into it. Today, we're talking about something huge, something controversial. We're asking a question about the very foundation of our entire economy. You see, it's the system that fuels our world. But what if I told you some people think it's all built on a massive deception?
So let's not waste any time. We're going to dive right into the heart of this accusation. It's a pretty shocking thought, isn't it? But that's the central question we're going to dig into today. And to do that, we really have to look past the common myths and get to the bottom of how money is actually created.
Okay, so before we go any further, to really get what Rothbard is even accusing the banks of, we need to be crystal clear on what a Ponzi scheme actually is, right? It's that classic scam where profits for the early guys are paid using money from the newer guys, not from any real earnings. The whole thing needs a constant flow of new money just to stay afloat. So keep that idea in your head as we dig deeper.
All right, so to really get to the truth of this, we've got to understand where our money actually comes from. And, I'm going to go out on a limb here and say the answer is probably not what you think.
Most of us have this picture in our heads of a bank, right? It's like a big, secure vault. We put our savings in, and then the bank takes that very same money and lends it out to someone else. Simple, safe, logical. Makes perfect sense.
Yeah, about that, as the Bank of England itself has stated, that common understanding is just flat out wrong. The model you see in some old economics textbooks, that's just not how it works in the real world, at all.
So here's the reality check. When a bank approves, say, your mortgage, it doesn't go and check a vault full of savers' cash. No, it creates the money right there, on the spot, simply by crediting your account with a new digital deposit. And at that exact moment, poof, brand new money just entered the economy.
So this is the really crucial point, this three-step process. The act of a bank lending money is the act of creating money. A loan creates a matching deposit, and that deposit, it's brand new money. It literally did not exist a second before that loan was approved.
And economists have this great name for it. They call it fountain pen money. Why? Because it's essentially created out of thin air, with the stroke of a banker's pen, or, a few keystrokes today, when a loan gets signed. This isn't money being printed by the government. It's being typed into existence by regular commercial banks.
Okay, so this incredible, almost magical ability to just create money leads to this fundamental conflict, a real tension right at the heart of banking. It's a choice between two very, very different systems with totally different goals.
And this table here, this really gets to the heart of the trade-off. On one side, you've got full reserve banking. That big vault idea we talked about. It's super safe, but it's also kind of slow. It really limits economic growth. But on the other side, you have the fractional reserve system, which is what we actually use. And that's the engine that finances businesses, mortgages, the whole shebang. But that engine runs on risk, a lot of it.
So, what happens when all that risk we just talked about stops being theoretical and becomes very, very real? Let's take a look at what happens when the magic fails and the whole system starts to break down. Look, the whole system is basically a high-wire act. It's a constant juggling game, balancing the money people are taking out with the money people are putting in. And it works perfectly fine, until it doesn't.
And when fear spreads, that's when you get a bank run. Just think back to the 2008 financial crisis. All of a sudden, the bank just can't pay everyone back. Why? Because most of that money we think we have is just a digital number on a screen, not actual physical cash sitting in a vault somewhere.
There was this economist, Hyman Minsky, who brilliantly predicted exactly how this happens. He saw lending breaking down in three stages. First, it starts out safe, responsible. Then, confidence grows and it gets speculative. And finally, you hit a stage of pure euphoria, what he literally called Ponzi finance. That's where the entire system is just betting on asset prices going up and up and up forever. And this quote, it just brilliantly illustrates the aftermath, doesn't it? The 2008 crisis was a classic Minsky moment. It was that exact point where the whole house of cards just came tumbling down. And guess who had to foot the bill? Yep, the taxpayers.
So, if the system is this unstable, it begs the question, right? Who's supposed to be managing all this risk? Who's actually at the wheel?
Well, to prevent constant collapse, there are supposed to be some guards in place. You've got central banks, which can act as a lender of last resort. Basically, they're there to provide emergency cash to stop a total meltdown. They can also set interest rates to try and control the pace of all this money creation. And on top of all that, there are regulations, especially new ones that came in after 2008, that are supposed to force banks to hold more cash and just be more cautious in general.
Which of course brings us all the way back to our original, really provocative question. We've seen how money is made, we've seen the risks, we've seen the controls that are in place. So, let's weigh the evidence.
Now that we've seen how money is literally created from debt and how fragile the system can be, what's the final verdict? Is Rothbard right after all?
And you know what? The arguments are really powerful on both sides. On the one hand, look, this system is the engine of our economy. It finances businesses and mortgages. And hey, it's completely legal and regulated. But on the other hand, it has these undeniably Ponzi-like characteristics, especially when you get to Minsky's final stage. And let's be honest, the fact that banks get to take the risks while taxpayers have to cover the losses, that just feels deeply, deeply unfair.
So here's the takeaway. While it may not be technically fraudulent in a legal sense, the critics, they have a very strong point. Those labels they use, from Rothbard's fake warehouse receipts to Minsky's Ponzi finance, they feel like disturbingly accurate descriptions of what happens when the system's built-in flaws are exposed for everyone to see.
And that leaves us with one final big thought. Our banking system. It's a double-edged sword. It has this incredible power to create prosperity and growth, but at the same time, it has an immense capacity for destruction. So the real question, the one we're left with, isn't really about what label we stick on it. The real question is, can we ever truly tame that risk without killing the economic growth that we all depend on?